Hi there. Thanks for joining me on Rethink Real Estate for Good. I'm Eve Picker, and I'm on a mission to make real estate work for everyone. I love real estate. Real estate makes places good or bad, rich or poor, beautiful or not. In this show, I'm interviewing the disruptors, those creative thinkers and doers that are shrugging off the status quo in order to build better for everyone. This is my second podcast interview with Brian Murray, but time has passed and his business and expertise have grown. Brian came to real estate as a non-real estate guy. Always interested in impact, he wanted to find a way to address poverty, and real estate presented a tangible path. And so he launched Shift Capital, an impact urban real estate group focused on mission-oriented real estate strategies in underserved communities. And so he launched Shift Capital, an impact urban real estate group focused on mission-oriented real estate strategies in underserved communities. Simply put, at Shift, Brian works on uncovering better solutions to society's most difficult urban challenges: intergenerational poverty, urban revitalization, access to opportunity, and community displacement. There's a lot to unpack here, so take a few minutes and listen in. Hey, Brian, I'm really happy to have you join me today.
I'm super excited to be here.
We are real estate developers who do things differently. That's what your website announces really boldly. So tell me what that means.
Sure. For us, what that means is that we are focused on building equitable neighborhoods, and we are focused in doing it in untraditional ways to the typical real estate development cycle. We focus on a hyperlocal approach. We focus on scale through that hyperlocal approach, and we focus on doing it holistically and really trying to dig deeper with the community beyond just participation, but equity building as well.
We're going to unpack that a little bit later, right? So,
That's right.
And how did Shift happen? What are its origins and how did it come about?
Yeah. By the way, in preparing to talk to you again, I went back and I looked through all your old podcasts, and I just want to say that the amazing people that you have interviewed over the years, I'm probably going to now make your podcast a requirement for anybody that we hire. Just so many good friends and great people, and a lot of people that I admire that I haven't met before.
It's been an enormous learning experience for me. I've really enjoyed talking to people and figuring out what's going on.
Yeah, I think you've really unpacked so many aspects of this quote non-traditional part of the real estate cycle, but I think people who are focused on all aspects of it, which is amazing. Sorry, what was your question? Your question was Shift origins. Yeah.
How did Shift happen?
Yeah, so I'm not a traditional real estate person. I didn't come up through the institutional real estate world and then come into development. I came into development with a goal to make an impact on poverty. My background was a mix of entrepreneurship, nonprofit work, Peace Corps, business school, et cetera. And I knew I wanted to combine all those things in a way that was creating effective impact. And what I mean by effective impact was I was struggling with the impact that the nonprofit sector was making. I was struggling with the idea of entrepreneurially just chasing money. And I knew I didn't have the personality for the government sector and policy, although I'm a huge believer that policy really drives a lot of this change. And so that ended up being an investment during business school in a small real estate deal in Philadelphia, and then realizing and really connecting with me personally that impact of real estate in people's lives, the physicality of it, how these things get financed, who's benefiting from this. And, as you've talked about and we share, real estate it surrounds our lives. We live in it, we breathe in it, we work in it, we walk by it. And in low income communities and communities that have been left out of investment, I think it's even more profoundly negatively impacting. And that's what I wanted to build. I wanted to build a company that was really digging deep into that challenge and thinking about how is what we're doing connecting with making people's lives better.
So, how do you approach that with each building project? What's the process like from beginning to end? Can you talk about that?
Well, we've evolved. We've been doing this for about 12 years, and in the beginning, I will share that I don't think we really had this worked out. I think we made a lot of mistakes, and we were making investments without an overarching strategy, and we were making construction mistakes and other things that were challenging. But ultimately, we have evolved into really two core philosophies. One is that we believe in investing in place. So place-based strategies, concentrating our investments. So it's really not just about investing in one building, it's about investing in a group of buildings so that we are maximizing that impact. That has shown up in our Shift Neighborhood Fund, in our work in Philadelphia, where we've really gone deep in now 3 neighborhoods in Philadelphia. The other way that it has evolved for us is realizing that our work can connect the dots between other challenges in the real estate sector. So specifically going through our own journey, and I'm a white male, which and carry a lot of privilege, but I found getting into the real estate sector to be the most harrowing and crazy and unbelievably risky thing that I've done. And I've been an entrepreneur my whole life.
Really?
It's set up to keep people out. And we combine that with, redlining and access to information and bank practices that are still happening today, to insurance practices that are now hitting our industry again in low income communities. And there's no wonder that that there are not a lot of women-led, Black and brown-led developers. And working in the neighborhoods that we're working in, we knew we wanted to do something. So we created a platform and a program to focus on that as well. So we do our own work. And we also try to uplift others through partnership as well.
Yeah, access to capital, really, that's what it's all about, right?
Access to capital, but not just capital, right? So for those of us who work in places where the numbers and the math don't work in a traditional sense, we also have to be experts at tax credits and subsidy sources. And with all of those additional items in the capital stack, the skill set needed is exponentially more than someone who's just doing a simple office product or what have you.
Oh, yeah. And I think appraisals are absolutely key as well. Early on in my career, I would have appraisers calling me just bewildered about what I was doing and not sure what comps to look at. And that's another skill set you have to develop, I think. Yeah.
It's a combination of factors, but and one of them is a spiral effect of groupthink that happens, right? I think the statistic is 95% of appraisers are white male, and in all likelihood not from the communities that they're appraising. And as Andre Perry and many others have pointed out, just a devaluation of urban Black and brown neighborhoods as a result. And so you combine that with institutional and capital staying out of those neighborhoods, afraid of being termed gentrifiers or afraid of the perception of safety. All these things combine to make real estate in the places we want to invest in much harder. And I only bring that up to say that it's not just about access to capital. It is truly challenging on all levels. And for someone who wants to do good and and maybe does have some of the skill set, the team that you need to hire to be able to do a larger project, it's an awful lot of money just to get a project off the ground. You can't make any mistakes because the numbers and the math are very difficult.
Mm-hmm.
And then you're not going to see a dollar yourself for maybe 3, 4, 5 years. And then
or longer.
or longer. And
Yeah.
what we have experienced ourselves, and I have been really pushing against this, is whether it's banks or investors, and even mission investors, believing that we need to continue to stick things in the same box. So what I mean by that is that when a project is we're 2 weeks away from closing, we've been working on a project for 2.5 years, and interest rates change. Well, everybody comes back to the developer and says, okay, well, now you need to contribute your developer fee, or you need to
Ugh.
defer your developer fee, or you need to get rid of the only dollars you're ever going to have to put food on your plate. Guess what? You can't have that either. And at that point, when someone's been working on something for 2.5 years, what are they supposed to say? They're going to get it done, and they give up the only way that they can
Yeah.
provide for their families. That's just not fair.
Well, I would I wouldn't agree, but still, yeah, it's really a very difficult business, I have to say.
Yeah, yeah,
I'm a developer and I have a portfolio thanks to my husband. I don't know because he supported us through all those years of waiting for something. Now we have a very nice retirement fund, so it's payback
yeah.
time. But I just don't know who someone on their own can do this. They have to be
Right.
getting an income. You have to be, and the problem with it is, Brian, for some reason, developers are painted as evil, money grubbing people across the board.
Yeah.
Maybe some of them are, but a lot of them aren't. So how did that happen? When you talk about giving up fees and just scraping by.
When we talk about, it's funny because I'll bring this full circle to the small change platform. And one of the incredible benefits of participating and being a part of, and we have now our second project on the platform. But one of the massive benefits is not that we're necessarily going to get thousands of people in the community to invest, is that we are going to expose thousands of people to the community to what happens behind the curtain. And, I do believe that the evil developer has been used as a tool that has negatively impacted a lot of the neighborhoods that need
Hmm.
good developers and good development and good investment, because it has filtered down from, watching maybe 30 years of center cities getting gobbled up for dollars, and then the truly evil developers of the world who have exploited opportunities, when in reality most developers are not, and are working within a system and just trying to put together things. This is not a business for someone to run in and make a ton of money quickly, and blood, sweat, tears, in 30 years. Yeah, I think it's a great business. um, but that's a lot. It's a misconception, both actually of young developers, and a lot of our work is helping to demystify and make sure that people understand the risk,
Yeah.
because a lot of people get into the business without understanding that they might be putting their home up. Uh, but I do think that translates down into communities. And this, I think the gentrification conversation is in that. I think the fear of change is in that. But using the small change platform to educate people, like, hey, wait a minute, look behind the curtain. This school project that we're doing, there is not a lot of money that we make, and there's a lot of risk that we're taking to get this thing done, has been really valuable. And I think we need to continue to educate communities on the positive side of inviting developers into their communities as well.
There's also the issue that investors maybe goes back to Sesame Street. They want immediate gratification. I actually had one investor say to me, "I've been investing in, I don't know, something that she was getting returns every 6 months. I'd like a short-term investment in real estate. I'd like to move into real estate. Can I get my money back in a year?" And I was like dumbfounded. A year's no time at all in the real estate world. Like, you'll have to wait a little longer. And I think that's also an educational mountain to climb, because everyone talks about portfolios, right? And yes, some people need to have a return immediately, but I think the value of real estate is that you can have something that will grow over time, in value in time. It's not about that immediate cash flow, but most people don't understand that. There's a big educational gap.
Yeah. And I think that's not just individuals. I mean, I think that the other factor that I didn't mention yet is just institutional capital. So
Yeah,
when we raised our first fund, we were pre-opportunity zone, a lot of stuff. And we were asking investors to invest in a neighborhood that had an average median income of $22,000, but we believed in for a variety of reasons. And, I wanted to do a 10-year fund. And I just said, this is not going to be an overnight thing. It's going to be a long-term investment. That's actually how we, seek to be more aligned with community if we're longer term. And my advisors at the time said, "You can't. The marketplace is. You're not going to raise anything. No one does 10-year deals and funds, and it's got to be 5 years." I said, "5 years is
that's like
impossible."
it's impossible.
Right?
It's impossible.
So I ended up doing a 7-year fund with 3 1-year extensions, is what I was able to pull off. And then, of course, the marketplace changed with the Opportunity Zone legislation, which changed mindsets to 10 years. But I believe that the real work is actually with the generational investment groups, the groups that can think generationally or think at least on 10, 15, 20-year time horizons. That's where the real value opportunity is. There's still so much capital chasing the 5-year cycle,
Mm-hmm.
and that is detrimental to investments in cities, which I think you have to inherently believe long term in
That's right.
cities.
Right.
But if you do, there's a lot of opportunity.
Because the hard stuff that really provides a return is it's just going to take a longer time.
Yeah.
Anyway,
Yeah. So, I think you combine that with, and I'll just make one last comment on this that I think is important, especially for those out in your audience who are talking to institutional equity and thinking about that source. The impact investing world has evolved and has really grown. 12 years ago at SoCap, which is the premier impact, I felt like we were the only real estate person there, and now it really is revolving around investment in community. But I have found that institutional capital still is on the 80-20 and 2 mold, which is, to simplify that down, at basically 2% asset management fee, and then a 20% promote over a certain equity hurdle.
and a promote, for those who don't know what it is what goes to the person who's putting the fund together or the project together. Yeah.
It's your pot at the end of the rainbow, but obviously, if your project doesn't work out, you don't have any of it. And so, I think in the impact space, there needs to be a reckoning on incentive structures that properly reward the amount of time and effort. Because an impact project, I mean, I'll put it toe to toe with any equity real estate group out there, is infinitely harder than if I'm buying triple net industrial across the country. I can have a team of 2 and do that. If I'm doing the type of projects that we do, the neighborhood investments that we do, I have to have a team of 10 plus, and the expertise is hard, and so we don't get paid for that, nor do we get the 2%. Now we have to also report on impact metrics, but guess what? We have to do all this additional work in this model that was never set up to. It was set up for a different world, honestly.
Yes. Yeah. Well, tell me about a favorite project and why it's favorite and how it met your goals.
Yeah, I'm going to get to my favorite project by just talking briefly about this next gen platform that we were doing.
Okay.
It started with actually a group in Philadelphia, Mosaic Development Partners, where a Sharswood Ridge project that we did on small change that created the framework for us to create this next gen platform. And our next gen platform is a platform where we are investing in and with what we call the next generation of impact developers. And it's the belief that we are seeking to help raise the game for developers who are trying to break into that next level of their business. And the majority, a strong emphasis on women-led development groups, Black and Brown-led development groups. And right now we're working with 11 different sponsors across the country, from Rochester, Ithaca, Newark, Baltimore, DC, Southern California.
And again, for our listeners who don't know what a sponsor is, that's really the developer, right?
A development partner. So instead of,
Right.
in our world, a lot of times developers have to look for allocators, so people who are allocating capital. And we're trying to come up alongside as a practitioner, as a developer ourselves, and recognize that it's not just about the money. It's also about providing and buttressing development groups who are on their growth path, but might not have exposure to new market tax credits, for example. And we're able to help lean in on that on a particular deal. So through this platform, about 2.5 years ago, we were approached by a Latino-owned housing group in Philadelphia called Voyage Investments. And Voyage was started by two gentlemen, Alex Robles and Juan Science, who went to undergrad together. Alex, both incredible pedigrees. Alex, many years in the real estate space, and went to Wharton from the neighborhood of Kensington, where our offices are. Juan, deep institutional finance experience, and they went off to start their own business. And I'd known them, and we would talk every once in a while, and I'd relay some advice, and they went maybe 2+ years trying to
Yeah.
put deals together and make things work. And of course, this was 18, 19, 20, and the marketplace was very hot, and it was very difficult.
I've got to add, I've worked with Alex. He's got to be one of the smartest, most responsive thinkers I've ever worked with. Really super impressive.
Yeah, they're both impressive. They're both incredible, but in this space, you need more than that. You need a little bit of luck. You need the right people to help you out, and they were just losing out on deals. And at the time, I had needed support. I needed help, and so I approached them in the conversation and said, would you guys be interested in embedding yourself within Shift for a couple of years? We'll create, I come from the venture world, or I had experience in the venture world, where they have these entrepreneurs and residents at the VCs. And I hadn't seen that happen in real estate. And I said, would you guys be a developer in residence? And, let's do a 3-year program, and you guys come on. And for the first year, you'll spend, a lot of time on our projects. And over the course of a 3-year period, we'll JV together, and we'll look for opportunities to help you guys out. But the goal is, at the end of 3 years, that you guys are back out on your own. But now, you've got a track record, you've got relationships that we help build up, et cetera. So Alex and Juan have been on our team for 2 years. We've done a project in West Philadelphia, which was a housing preservation a deal. And then we found a deal locally in Kensington, which was a 40,000 square foot warehouse space. Alex is from Kensington. This is right around the street from our offices. And we said, hey, how about we partner on this one together? So we partnered up with Voyage, and we had this warehouse, and we said, and we actually at the time had a tenant. It was going to take the whole thing. The tenant was a ceramic company that was part of our ecosystem. So we are one of our bases of philosophy is really investing in the creative economy. I know you've had my good friend Lindsay Scanapico on recently, and we share a lot of similarities in terms of things that we've done in the Philadelphia area. But one of our companies was a ceramic building business that was growing out of its space, and so we partnered up with them to buy this building. This was going to be their future home. They were going to grow into it. And we bought it together. We started moving down that pathway, and the construction cost to build out their space was more than they anticipated. And so they decided they wanted to back out of the deal. They wanted to stay as partners in the deal, but they no longer wanted that to be their future home. So maybe about 3 or 4 months later, we ended up getting approached by a school called Big Picture El Centro, which is a opportunity youth school in Philadelphia. For those, and this is education for me as well, an opportunity youth school is focused on youth who are struggling in the traditional system, and this provides them an alternative pathway to graduation by focusing on skill set education, on putting these kids into businesses earlier in apprenticeship programs across the spectrum from culinary to trades, et cetera. And they were looking for a permanent home in Kensington, and their timeline was really tight. They could only move in half of the building at first, but they did want to go into the whole building. And so Alex, Juan, and the shift team, we put our hats on. We put together that lease, and we are building the future home of El Centro. And for me, it's probably one of the more rewarding projects that we've ever done. It checks all the boxes of impact for me. We're I think making a healthy return for the risk, but not an egregious return to make sure that we are providing the most economical space we can for the school. We are building a high quality school. I say that because Philadelphia is marred with a education licensing system that is really problematic for building good schools. The charter school system is on a 5-year program, and schools are really not able to pay a whole lot. And that combination means that the private sector is not really able to step in very often and build higher quality schools. But we feel we've been able to thread the needle on this one. And so the plan is for them to move in January. We're about 60% through the construction. We are partnering with Small Change on this project to provide opportunities for people in the neighborhood. And again, going back to this importance of education and involvement and access, we couldn't be more thrilled to be bringing this project on there as well.
But just about the finances, you're actually raising quite a lot of money through on Small Change. So what's the financing been like for you on this project? Because it's an odd start construction and try and figure out the financing as you go strategy, right?
Yeah, this is one, I'll look back and say, man, this was a tough one. We knew the school needed to move fast. We knew they didn't have a lot of options, and that they were getting a lot of pressure from the district to move to Kensington. And so we pulled the trigger, and I'll say this, we actually started construction, earmuffs here, before we got the lease signed.
Oh,
Just to give you a sense of
I've done that.
how much we
Earmuffs.
leaned into this.
Yeah.
By the way, no
No.
one do this. Do not do this. But we had a lot of confidence that we were going to get the lease done. We had built a very strong, very relationship with the board, with the leadership team, and we knew that the pressure was on for them. And so we really wanted to get them in earlier. But construction has pushed us to moving them in January. But to close on a project, to sign a lease where not all of the equity and the debt is together, is certainly a terrifying place to be. We're in a much stronger place now. We do have, and we're closing on our construction debt, about $3.9 million in construction debt, maybe as early as next week, which we're in October right now. We are raising $2.4 million. We've put in $800,000 ourselves. We've also bridged a lot of this construction during this time, and we are seeking both accredited and non-accredited. So we're doing a side-by-side raise, and we're out there talking to a lot of groups right now on the accredited side, but and meeting with community groups on the non-accredited, looking to raise awareness.
I have a question about that. How do the community groups respond to this? It's an unusual opportunity for them, right?
It's been fantastic, and I will say that the Voyage team, especially Alec, as a native person from Kensington, has really been on the front end of this, has been excited to be able to talk about this. And, I would say that a lot of this is really, it's a very soft sell, right? I mean, we're using this as an opportunity to educate as much as possible, in
Hmm.
addition to saying, hey, this opportunity is here, but not, but be realistic in terms of where people are.
It's more about like this is your neighborhood. This
That's
is
right.
this is the value it's going to add to your neighborhood. There's value here
That's
besides
right.
a return you might get on the dollars you invest, and that's actually a lot to think about, I think. Um,
Yeah, I think this neighborhood, for those unfamiliar, Kensington, was on the Republican national debate stage as the, worst place in America.
oh,
We were the center of the opioid crisis. We are dealing with $1 billion drug trade, just blocks away from here. This community is resilient. It's a big, second generation Latino community. It's a very mixed community, old generation, new generation, lots of kids. And to take a building that has been vacant for 25 years and to put it into productive use like this, positively, and for them to be able to see how, and pull back the curtain, allow them to see that happen, is just very rewarding for us.
I have to ask, how did you end up in Kensington, and why the worst neighborhood in America?
Well, a little bit happenstance, but Kensington was the workshop of the world for the textile business at the turn of the century. And so it has two really incredible things going for it from a real estate perspective. One, it's on public transportation. There's only two subway lines in Philadelphia. And so we had a long-term belief that Philadelphia was going to turn from a car city into a public transportation city. So everything we purchased within a 5-minute walk to a subway station when we got involved in the neighborhood. Two, as a result of being the workshop of the world, there's a lot of larger real estate and older buildings that we could adaptively reuse, and we could purchase at a low basis at the time. And that low basis, for those interested in impact, I cannot emphasize enough how important low basis is to doing the work of impact. It gives you flexibility, that if you buy in, later, you don't have as much flexibility without a lot of subsidy. And so those
Yes.
three things really were what brought us to Kensington. The reason for it being a challenged neighborhood is very complicated. It is just north of some of the hottest neighborhoods in the country, with Fishtown and Lower Kensington. But this neighborhood has been ring fenced by the city, and drug trade has been allowed to happen. And that has, and again, I don't want to get too deep into the politics of it, but I would say, it is largely so that it doesn't spread to other neighborhoods in Philadelphia. This neighborhood has pretty much been sacrificed, in my opinion. It's an incredible tragedy, but within that tragedy is this incredible story of a phoenix rising that we're proud to be a part of, and proud to work through with the community that's there, that's continuing to want to live there and want to see this neighborhood come back.
I'm going to shift a little bit because that's a pretty incredible story. But I just want to know, how big is your portfolio now, and do you have an end goal in mind? And are you working anywhere other than Philadelphia?
Yeah, so our Philadelphia portfolio is probably about 1 million square feet. We have a number of projects in development right now. Outside of Philadelphia is through our next gen platform. This is where we are working in Rochester, Ithaca, Newark, Baltimore, DC. Our portfolio as a whole is probably about 3 to 4 million square feet, which is that's pretty remarkable to say that out loud now that I think about it. But it's largely been through sharing, partnering, joint venturing in a way that feels, very, very appropriate. We're about 30 people, so we're vertically integrated within the Philadelphia marketplace, and we'd like to, lend ourselves into other marketplaces where needed. I would
Mm-hmm.
say that, we have been at the forefront of thinking long term, how do you create mixed income communities? So from the day we started our work, we were thinking about our exit strategy. We helped put together the first neighborhood trust in the country, which is the Kensington Corridor Trust. I know you've had David Kemper and Trust Neighborhoods, which is a corollary group that started
Mm-hmm.
about the same time. Um, Adriana Bizeta, who leads the Kensington Corridor Trust, should absolutely be a someone you interview.
Oh, send me the information. I was just writing this down.
So the Kensington Corridor Trust, and I can't speak for them, I got kicked off the board, which is a wonderful feeling. But they own probably a couple blocks now in the Kensington neighborhood. They've been buying their own real estate on behalf of a mission for the community, and that mission is to
Oh, yeah.
preserve affordable workspaces on the corridor. And that model, I'm excited to say, is now starting to spread across the country. And so we are constantly thinking about exit. How do you preserve in advance? I'm a big believer that while I think the LIHTC, the low income housing tax credit tool, is probably one of the greatest tools ever created, at the same time, it's a reactionary tool. And the mindset should be, when we have that low basis of real estate in a lot of places, now's the time to think about preservation. We need to think about preservation on a 20, 30-year
Yes, yes.
scale. And we need more tools. We need more financing groups. We need philanthropy. We need investors to think more strategically about how do we think about capital long term. If you told an investor they could make 8% returns over a 30-year period, it's great return.
It's a great return.
Unfortunately, when you have short-term investors who are only, I need 15-20% returns on a 5-year schedule, and then you compound that over 30 years, you're at a much different place. And that is a detriment to
Yes, yeah,
neighborhoods and
yeah.
and cities, and it's a problem we have to solve.
Yeah, I agree. And I think that impact investors I've talked to have been an enormous disappointment to me, because I think that longevity is definitely part of the equation. But what I get is, what's your exit strategy and how soon? They'll talk about impact, and then it's what's your exit strategy and how soon? And I just want to build the best platform I can that will serve the most people.
I'm
So
gonna
I
give you a little
don't know what
optimism, all right? And
I don't.
I have been in the
Yes,
doldrums with you. I have seen the slow
yes.
march forward. And having been there when the only investing impact investors were doing was in CDFIs and affordable housing, to this, a place-based mindset. I believe that although it's taking a lot more time, that we are seeing more and more investors getting that message. And I do think it's these podcasts, Eve. I think it's, the cadre, the community that's gotten created over the last 10 years of people saying these things. And I I really believe it needs to come from family offices, in particular, who have the ability to think long term, as opposed to I don't, the Black Rocks of the world, so to speak. Getting into impact investing is not where it's going to come from. It's going to come from the next
Mm-hmm.
generation of families who, there's a big transition of wealth. And if you look at things like the Durst organization, right? I mean, they invest generationally. And I do think that more and more families are going to start getting this message and understanding that they can be part of the solution. It's already happening. We're having some conversations, and I feel like the message is
Yes,
getting
yeah.
through, even though it's not fast enough and it's not enough yet. I mean, certainly not enough. Yeah,
It's not fast enough. No, I mean, we have thousands of users as well who must have an interest in impact,
yeah,
because that's all we offer investment
yeah.
in, right? So, but it's not enough. It's not enough. When you compare it to the hundreds of thousands who are investing on platforms in ways that have absolutely no impact, they're just, yeah, Depressing. Okay. So, last question. What's been your biggest challenge and biggest disappointment?
Um,
Maybe that's not an uplifting question to end on, but I'll ask you that and then.
no, that's okay. I mean, yeah, I think it's the right question when we're talking about development, because there isn't a day that is not challenging that we go through. Sometimes I feel like I'm whether it's whack-a-mole or whatever the right metaphor, whack-a-mole, or you're plugging at the dike over here and then a leak happens over
Oh,
here.
yeah.
And one of the challenges is keeping positive through that and recognizing that the small incremental movements forward are going to be part of the big movements later. It's been very difficult to grow the team that we've grown. We've taken a lot of risks. My team has dealt with a lot of stress. We've gone through periods and where payroll is an issue. And I've had during COVID asked the team to not take payroll for more than a month, to just help us get through and try to keep everybody together. I have a goal maybe one day in life to write the developer confidential book that needs to be written. I think based off of the Kitchen Confidential book that Anthony Bardot wrote. But there is so much behind the scenes that's challenging. I would just say keeping people positive in the wake of what feels like insurmountable challenges and pushback, and is definitely our biggest challenge.
So, I'm going to ask you, if it's so challenging, why do you do it?
Oh, why do we do it?
What's the
Um,
rewards? Why do we do it?
it depends on what day you ask me that question. Some days I'll say, well, if I knew then what I know now. Um, but most days I really feel that real estate is the most impactful and um, important thing to combat the challenges and the ills of today's world. Whether that's the idea that real estate spaces can bring people together, whether it's about financing and how do we bring positive dollars into low income communities and bridge an equity gap, um, wealth building. I mean, it touches so many things that for me, that I can wake up every day and say we're doing something positive for society. And that's why we do it. Yes, I love the building and I love the physicality side of it, and I that is important. But I would say, arguably, the people side of buildings is the most important for us.
Well, thank you very much for joining me, and I can't wait to see what you do next. This current project is fabulous, so I'll be watching.
Well, I mean this. You're a gem to this whole world and this movement, and I'm just so happy to see how much you've grown and how much you've built this thing. And I think I'm just really excited to be back on the podcast. So thanks for having me again.
Well, thank you. I hope you enjoyed today's guest and our deep dive. You can find out more about this episode or others you might have missed on the show notes page at rethinkrealestateforgood.co. There's lots to listen to there. Please support this podcast and all of the great work my guests do by sharing it with others, posting about it on social media, or leaving a rating and a review. To catch all the latest from me, you can follow me on LinkedIn. Even better, if you're ready to dabble in some impact investing, head on over to smallchange.co, where I spend most of my time. A special thanks to David Allardyce for his excellent editing of this podcast and original music. And a big thanks to you for spending your time with me today. We'll talk again soon, but for now, this is Eve Picker signing off. to go make some change.